Before we start the show, Andy, I'd just like to say a quick thank you to our podcast sponsors this week. Firstly, Fidelity International. For more information about them, please visit fidelity.co.uk/money to the masses. Also, Wealthify. For more information about Wealthify, please visit wealthify.com. And Hargreaves Lansdown. For more information about Hargreaves Lansdown, please visit hl.co.uk. When investing, your capital is at risk, which means it is possible for the value of your investments to go down as well as up.
Hello and welcome to episode 360 of the Money to the Masses podcast with your resident expert, as always, Damien Fay, and me, Andy Leeks. Damien, welcome back to the show. How are you doing?
I'm good, Andy. I say I'm good. You and I are both battling with colds at the moment, so I'll throw in an early apology to listeners if Andy and I sound a little bit off key today, because we're trying to struggle through.
Yeah, so weirdly, we haven't actually seen each other in person in 2 weeks. We definitely haven't caught anything off each other. No germs have passed between us, but we're obviously in sync. So yeah, apologies on that. But hey, we crack on. It's fine.
Yeah, but to cheer us up, we had a couple of nice reviews this week. I have to say, it was our 500th show last week, and we made a small thing of it and asked for you to send in your reviews. 2 of you responded, which I have to say I'm a little disappointed about, given how many of you listened to the show, but we'll move on from that. But there was one of the reviews in particular that Andy's going to read out did make me laugh, because somebody had gone all the way back through our back catalogue.
Okay, so the first one is from Greg, and to be fair to Greg, he did mention that he found it a little bit difficult. So he's an Android user, and he also listens via Spotify. It's not the easiest way to leave reviews on Spotify, so he found a way. He does use an app, and it was Podcast Addict. I've actually used that app, and it's pretty good. And he popped a review on there which says, if you are confused by money matters, then this is a 5-star podcast to help you demystify anything financial. Damien has a knack of making complex topics seem simple with some great analogies, and Andy comes in with great questions that help cement the understanding. I've been making my way through the back catalogues, awesome evergreen topics, and the guys have done their best to not date the content, which is a challenge with tax rules and market movements, etc. Thank you for sharing and keep up the great work. So thank you for persevering, Greg. Yeah, apologies to people who struggle to leave reviews. It doesn't really matter where you leave your reviews. There are lots of places you can do it on the various different apps. So long as you do that, it does help us to sort of rise up the charts on those individual apps. Not everyone uses the Apple Podcast app these days. We appreciate that.
And for his efforts, Greg, I will send you a Money to the Masses mug. So I will reply to you, because I've got your email address actually, and you can have a Money to the Masses mug for your efforts of sending in a review. But Greg actually did a follow-up, didn't he, to that particular review, where he pulled out something from our back catalogue that did make you and I laugh.
Yeah, he did, absolutely. He said, by the way, please bring back that cheesy American intro voice on some of the older episodes. He's a classic, especially at 1.5 times playback speed. And my favourite nugget, he says, excuse the pun, is money is their food and drink, so much so they poo gold. Now, David, I remember that. We back in the day when we first started the podcast, we asked someone to go and record a load of podcast intros, and there was maybe 5 or 6 different versions on there. That was one of them. And I've got to be honest, when I edited the podcast, when I listened to that, it just didn't really feel on brand, pooing gold. But
ironically, Andy, I think you wrote it, because I think we had to write the scripts for the person to read out for the American guy. So although you say it wasn't your favourite, I think it was probably like you saying it was your least favourite joke.
Yeah, I probably did write those, and it just goes to show that my sense of humour hasn't improved over time.
So just to explain to listeners who haven't gone through our back catalogue, we do make the content evergreen, so do go back through the catalogue. But when we first started the show, it's probably 7 or 8 years ago, then it was very kind of a trend to have American voices on podcasts doing kind of comical intros, that we kind of absorbed that into the style of what we were doing at that point. And that was obviously because we were one of the first UK money podcasts, to be honest. Podcasts weren't the thing that they are now. And so as time evolved, we kind of moved away from that, and the show changed. And I think we actually had some feedback from some people saying it didn't do us credit, so we ditched it. But we did tried to find the clip that Greg mentioned, but we couldn't find it because you have to go way back through it. But while talking about speeding up the show, one thing that does make me laugh every week is I listen to the show at twice speed because I check the content to make sure it makes sense. There's nothing that hasn't been missaid or something that needed to be added to caveat or anything like that. And when I do, I listen to the intro music at twice speed. So if you can speed it up and play it twice speed, Andy's going to put the clip in anyway now twice speed because it sounds like a drum and bass track, and it sounds like a completely different kind of podcast than one that's to do with money. And I quite like the drum and bass version, if I'm honest. I'm almost veering to having it as the correct speed for the intro music.
I'll tell you what I'll do, Damien. I'll stop you there. I'll pop it in now. Listeners can see what they think. Here we go.
See, I told you. It's brilliant. I love it. Anyway, shall I tell you what's on this week's show, Andy?
If you could.
If you could. I think we've been going a while. Right. On this week's show, I'm doing a piece about Sharesave schemes. I've realised we've never done anything on Sharesave schemes, and we've had questions from people in the past, and I thought, it's time to do a piece on Sharesave schemes, what they are, how they work. I'm also going to talk a bit about Grow It, because that's our new campaign that we're doing. And I think there are a lot of people who listen to the show who are unaware and would like to join up on Instagram and take part in that. And we're going to do a piece about accountability, really. It was International Women's Day this week, so Harvey's coming on the show to explain what we're doing as a company about engaging our female audience. And also, finally, Laura's coming on the show to talk about the state of the mortgage market, because deals are being pulled and the market is changing rather quickly. So it slightly dates the podcast, but it's particularly relevant at this point in time.
Okay, should we start with Sharesave schemes then? What have we got?
Okay, I want to talk about Save As You Earn schemes. And it's interesting because we've got to like 500 episodes of this podcast, and you all have some wisdoms that are passed down to you from your parents, and some people, it might be investing in property, for example. But I always remember my dad said to me as soon as I started working, if you ever get the chance to be in a form of Sharesave scheme at work, so a Save As You Earn scheme, often called SAYE, then jump at the chance. And in fact, in my first job, which was working for a major UK bank, I did get the opportunity and I did join the scheme. But it's funny that given it was probably the one wisdom that he passed on and he was very adamant about, because it was a good way of growing wealth or saving for the future, I've never talked about it until basically our 500th episode of these podcasts. So what is Save As You Earn? Save As You Earn schemes, also known as employee share ownership schemes or share save schemes, came about in the 1980s, and they allow people to regularly save via their payroll at work over a 3 to 5 year period. And what happens is you put money aside each month for a 3 to 5 year term, depending on the scheme. And then at the end of that period, you have a choice of simply getting that money back with, theoretically at least, an interest payment, or buying shares in your employer at a discounted rate. So that's how they work at a very high level. And the idea is that you can share in your employer's success because you effectively invest in the shares of the company you work for, but you get them at a discounted rate. So in order for a company to run a Save As You Earn scheme, they need to be a public company listed on the stock exchange. So take something like the FTSE 100, or owned by a public company that is listed. Now, to give you a sense of scale, there are 14,000 companies in the UK that operate these schemes, which just goes to show that a hell of a lot of our listeners will have access to these schemes if they want to take part. And what happens is you can save between £500 and £500 a month from your net pay into these schemes. And how they will usually work is that each year you are invited as an employee to take part in the scheme. So you can decide that you want to save £50 a month into the scheme. Then every month from that point thereafter, for the term of this scheme, which is usually 3 or 5 years, then you will save £50 a month. And that money usually goes off to be held at a bank, for example, as part of the scheme. Then At the end of the period, you have a number of choices, which I will come on to in a second. But I mentioned limits there of £5 to £500 a month that you can save. Now, technically, the employer can tweak those limits, but we'll stick with the idea that it is usually £5 to £500 a month. The key thing is the maximum of £500 a month goes across all of the schemes that you will be eligible to take part in. So as I said, that each year you may be invited to take part in a scheme. So you may, for example, take part in a scheme in 2021 and you decide to put in £50 a month. This year, you may get invited to take part in a new Sharesave scheme, and you might decide to put in £100 a month into that one. So technically, you've got £150 a month coming from your net pay that are going into two different schemes, and they may both, let's say, run for the same period of time. And we'll use an example of 3 years. So you can see you're in one scheme already that is running for 3 years, has been running for a year. You're doing £50 a month, and you're in a new scheme that's just started that will run for another 3 years, that you're investing £100 a month. The key point is if that cumulative total you're putting in a month is £500, you can't join a new scheme until you're paying less than £500 a month. So that means that if you get invited to join a scheme when you, let's say you join an employer, you go, I'm going to put in £500 a month. Then next year, you couldn't join the next Sharesave scheme. And the way these things work is that obviously at the end of the term, they effectively mature. And that's where you have the options of what you want to do with the money. Like I said, I'll come on to. And so if you keep joining these schemes over a period of time, then every 3 to 5 years, depending on the term of the scheme, you will effectively get a potential windfall. And that is why they can be very good ways to save. And because you get a discount on the shares in your employer. Now, the share price is set at the start, and there is a maximum discount of 20% off the market price on a set day before the scheme starts. So when you get to the end of the scheme, the price which you then can purchase the shares is already set in stone. And so you now know what the market rate for those shares are in the general marketplace, but you can see the price that you can buy them at with the money you've accumulated over the 3 or 5 year period. And of course, that price was discounted anyway. So you can see they're incredibly attractive. Now, every year there will be a deadline for these schemes. So they will invite you to join and you have to get your application in quickly. And if it becomes oversubscribed, because what they will do, there will be a certain limit that the employer will want to offer in terms of discounted shares, they may do something called scaling down, where they effectively knock everybody who's applied to be in the scheme, they knock down the amount that you are able to save into the scheme by the same proportion, just to make it fair. Now, when you apply, it's set in stone the amount you contribute. So let's say you did decide to put £50 a month, it is therefore £50 a month from that point until the end of the scheme. And you can't do ad hoc payments. And of course, if you wanted to put in more, then you just need to wait until the next year's scheme comes along and you can join that one. Now, where this is exciting is when you get towards the end. And at the end of the scheme, you have a number of choices. Now, typically, you may get a bonus at the end on top of the amount of money you've saved, but that amount is dictated by HMRC. So at the moment, it's nothing. So effectively, what happens at the end, you'll get the money that you've saved in, and you can decide to either just take the cash back, because let's say, for example, you worked for an employer and the share price had completely tumbled, so it was even lower now than it would have been at the price that it was agreed you could purchase the shares at under the rules of the Sharesave scheme, then you wouldn't want to buy shares that would immediately be worth less in today's market. So you might decide, you know what, I just want the money back. And that is why Sharesave schemes are seen as a very safe way of saving, because effectively you're just putting money aside. You won't get a decent interest rate, unfortunately. You would get more than if you put it into a savings account, but you have this option of being able to buy shares. So the second thing you could do is actually buy the shares in your company at that discounted price and immediately in the same transaction sell them. You then effectively get this windfall, and that will work if your company's share price has risen, for example. And there is obviously a CGT liability, but that's if you are making more than your capital gains tax allowance on your Sharesave scheme, which obviously for lots of people won't necessarily be likely, but it is possible. The other alternative is you can buy the shares and just keep them. And obviously that can become risky over time, because if you worked for an employer and every year after the 3 to 5 year period, you would start suddenly getting more and more shares in the company you worked for, because the money you put in the schemes of buying those shares, then your wealth will become more and more concentrated in a single company's shares, i.e. your employer's shares, which is a very risky thing to do. So obviously the best thing is to diversify your investments. So that is one option. You could buy some shares with the money at the end of the term of this Save As You Earn scheme and then sell some of those as well. Or you could buy some shares and keep some of the cash. But you have a 6-month period in which to decide what to do with the cash that's in the scheme. So you can't just sit there forever not making a decision. Or you could obviously do nothing, not make a decision, but like I say, in 6 months' time, you've got to do something, whether you get the money back or you decide to buy shares. But the reason why these schemes are very interesting is because they are effectively a risk-free way of saving, because the money, like I say, is held at a bank, and you are covered by the Financial Services Compensation Scheme up to that £85,000 limit. There is therefore the potential of just getting your money back, or you could make a sizable profit if you're fortunate, if your shares in your company rocket during that period of time. Well, they don't have to rocket, they just have to go up. And you obviously buy shares at a discounted price, and that can be very attractive. Now, obviously, there are people who perhaps this isn't necessarily a great idea, and that's if you've got lots of expensive debts. You should be really paying down those first. If you've got no spare income, you're really living hand to mouth, then obviously putting money in a scheme is not necessarily a good idea, or you have no emergency fund. So they're the things that you need to tick first. And of course, that goes for any kind of investing anyway. And when we talk about sort of debts and expensive debts, we're not talking about your mortgage, obviously. And okay, there's a case of people who have debts that are manageable and they're on 0% interest rates, then they may obviously decide to join such a scheme. But it's a really good way of dipping your toe into investing. And as I say, you can do it from as small as £5 a month. So something for people to look at. It's one of those rare occasions where the advice that you're given, probably from a parent, is actually pretty decent advice. So I hope my dad forgives me for leaving it this long to actually mention it on the show. There is one thing that I haven't mentioned, which is what happens during the 3 or 5 year period if you decide that you want to get out, or like you might leave the employer, for example. Well, the good news is you get your money back, and technically you can get your money back with an interest payment. But again, that interest rate is set by HMRC and it's currently zero. So when I did this many moons ago, because I've not worked for a company for a long time that offered such a scheme, but when I first did, then one of the schemes that I ended up joining, I ended up leaving early because I left the employer and I just got the money back. So again, it was almost like a form of saving over a period of time, and it was actually quite a nice windfall for me when I actually end up quitting that scheme. Now, there are some nuances of the scheme of what happens if you go on a sabbatical or you have extended paternity leave. And obviously, if you go on a sabbatical, you might not be being paid, but you can agree to pay standing orders to cover the monthly amounts that go out into the scheme rather than coming from pay, because if you're not getting paid technically, but you're still employed by that employer. Now, there are other things out there, other schemes that employers run. So one of them is called a share incentive plan. That is something that's very different. I'll just quickly touch upon it, but a share incentive plan allows employees to own shares in their company, but there are different ways in which it's enacted. So you can get free shares. So your employer can award you up to £3,600 worth of free shares in any tax year. And it can be tied to individual or team performances. There are things called partnership shares, which again I won't go into, but you can buy partnership shares using gross pay. So it's different to the Sharesave schemes I've mentioned. However, there are limits on those, which are £1,800 a year or 10% of your total salary. And there are matching shares, which is if you buy partnership shares, your employer can match them by giving you up to 2 free shares for every one you buy. And there is something else called dividend shares. But the point is, there are some other schemes out there that do also exist. And we'll link to the official government sites to give you more information. And if you keep the share incentive plans for 5 years, then you won't pay income tax or national insurance on their value, and you won't have to pay capital gains tax on the shares you sell if you keep them in the plan until the point of selling. So I said we'll put a link, and there's also something slightly different called RSUs, which stand for restricted stock units, which are quite popular with technology companies, particularly in the US. And what happens with those is that you are, for example, given 100 restricted shares or restricted stock units, they're called. And then over a period of, say, 4 years, they vest. So you'll basically be able to get access to those shares. And every year thereafter, you might get another, let's say 100 shares, for example, and they vest. So it kind of is a way of getting shares in the company, which are then vested over periods of time while you work there. So it means that you effectively can get some kind of windfall every year while you work for a company. I'm not going to go into too much detail because most people have never heard of them, and it's quite complex, but just to say there is this other thing out there, and they're taxed completely differently as well. So you end up having to pay national insurance and income tax when they vest. But again, it's a slightly obscure thing. For most people, save as you earn schemes are the ones they're going to come across, and they are a very good way to start to get into investing and a good way to save money as well. But of course, they can be used to complement the other types of investing you're doing, which includes investing in ISAs, for example, and includes your pensions at work, particularly auto enrollment, where you will get matched contributions as well.
Okay, so there we have it, save as you earn. And actually, it's timely this week because we're talking about savings and how you grow your wealth. And so, Damien, Grow It is our focus this week, and you want to talk a little bit more about it.
Yeah, so I want to get everybody involved who listens to the podcast. And one of the things over time is that we are very aware that people come to the podcast, come to the website, and they consume the content, but we want to give them an organized way in order to go through some of the content we do to help them understand particular topics. So we had Own It and Fix It earlier on in the year. So Own It was helping people build their black books about their finances. Go back to our Instagram account and you'll find links to that. We'll explain everything about Own It, or search Own It on the website. But basically, it helped you understand where your finances were, built a nice black book of your finances so you can take control of them, and also for people in your life, spouses, partners, to understand your family finances, especially if you were to unfortunately die, because there normally is one person in the household who is the main person who looks after finances. So that was Own It. Fix It was resolving the issues with the help of a series of tasks, as well as the MOT that we've built 3 years ago, which continues to help so many people. I think it's 37,000 people have done it for free so far. And Grow It is the next phase, because once your finances are in order, then the next thing you want to do is starting to grow your wealth. And that includes savings and also investing. And that's through things like ISAs and pensions. So this week is the start of Grow It, and it lasts for 4 weeks. And if you go on our Instagram account, you don't have to sign up to anything. You'll just see me every day talking about the tasks and providing links through to the Grow It campaign on our website, where every day there's a task for you to do, which usually is reading or listening to something so you understand an area of finances. And if you're new to investing, it doesn't matter. If you're experienced, it doesn't matter. There's something in there for everybody. And ultimately, the aim is to educate people so they can make a decision and a step forward on their journey to growing their wealth, and be able to start investing as well, so to empower them. And so this week is week 1, which we've just come to the end of, and next week is obviously week 2. Week 1, we talked about investing, whether it was right for people. So investing isn't right for everybody. So on that last piece I did about the Save As You Earn schemes, I mentioned people who that wouldn't be right for. And it's the same group of people effectively when it comes to investing. So there's links to content, video, audio, which helps people understand whether investing is for them. Then on day 2, I moved on to investment risk and volatility. They're 2 different things, and I explained how they work. Setting goals and deciding investment timeframes was day number 3. And that is one thing that I think a lot of people struggle with. So that again linked back to an old podcast in there where I talked about how you achieve financial goals, which was episode 173. I then did a piece on day 4 about investing in different types of assets, the importance of understanding not only what an asset is, but also the different types available, and how to even think about beginning to build a portfolio. Day 5 was about cash as a destination. So improving returns on cash. That's not just looking at best buy tables, which we have on the website, but things like cash ladders. If you don't know what a savings ladder is, then you want to look at Grow It and day 5. Also, cash savings platforms that exist out there that help you quickly move accounts and get the best savings rates. Again, we explain more on day 5. Before, we talked about the basics of investing. So understanding how things are taxed, like I mentioned on the Save As You Earn schemes, and things like ISAs and why you would use them. There are people who won't understand those topics, and we need to introduce that to them. And then obviously today, which is day 7 technically, is a rest day, but there is a task of subscribing to our midweek market show where I talk about investing, so you get an understanding, even if you're a passive investor, of what's going on in your portfolio. So Grow It is our campaign I want everybody to take part in. Go and look at our Instagram account. You'll find a highlight that tells you everything you need to do. If you've not done Own It and Fix It, go back and do those. But Grow It is a good way of increasing your understanding of investing, and for people who are new to start to get into it and explore whether investing is for them. And to be honest with you, investing is for everybody. Obviously, with that caveat, for the exception of those with debts, etc. But do please let me know what you think of it. Anything else you will need to add. We will come back and continue to do this and repeat the exercise at dates in the future. But you don't have to follow it as I produce the Grow It campaign at the moment. So you could do it at some point in the future. You can go back to day 1, even though it's day 7 now. Doesn't matter. All you have to do is make sure you complete the task in sequential order, because it has been designed to help you navigate those important topics. So you learn, build on what you've learned the day before, so you can understand those topics. And eventually we do finish off at the end, after we've covered all types of investing, including pensions. We do some of the esoteric topics. So things like crypto on there as well. So I'm really excited about Grow It. So please do let me know what you think about it.
Okay, great. So let's move on to the next piece of the podcast, where we'll be inviting Harvey back onto the show. Now, Harvey's going to be talking about something we were talking about and are passionate about in the office this week, and some conversations that we've had and reflections really on how we've been serving our female audience. Now, of course, it was International Women's Day the week just gone, and it's a perfect time for us to be talking about this. So Harvey, welcome to the show. Thanks for coming on.
Hi, Andy. Thanks for having me back on. Yeah, so this last week we've been talking, and actually for some weeks we'd been reflecting on the last year, and we'd gone out of our way to try and discover some things about our female audience last year when International Women's Day came around. And there were some interesting findings from that survey that we wanted to share with our audience on the podcast, and also just reflect a little bit on where we are at Money to the Masses and what we think we're doing, what we would like to continue to do, and what's coming up for our female audience as well. So we carried out a survey. The survey told us that 60% of women agreed that personal finance was a bit too male dominated. 63% of the women felt there was too much jargon. I think that's probably felt by more than just the women, but specifically the women felt there was too much jargon in personal finance. And over 80% of women showed a keen interest in online learning to improve their financial knowledge. And, a lot of it was underpinned by a desire from our female audience to build resilience and independence in their financial lives. And we had reflected on the findings of that survey last year, put in motion a few things that we were doing. But these are things that we generally do anyway, because we're trying to stamp out all kinds of elitism, not just the gender-based elitism that we face in personal finance. So just to share a few of the things that we've done, we've fought a lot of jargon. We continue to do that. We always have done that. We speak in plain language wherever possible, explaining as we go some of the technical terminology that you might come across in personal finance. And we've recently put together an investing jargon buster, which you'll be able to access, which should give you even more tools to help you with understanding some of the jargon in that space. What's really important to us, Andy, has been keeping a lot of our language gender neutral, so we're not putting people in boxes. That's a really important aspect of how we address our audience, and that we're not particularly assuming that males or females in households are leading or making decisions or are earning more. And with that in mind, we've been looking at a lot of ways in which we can address caregivers, homemakers, as well as the breadwinners inside homes, because we know that in order for homes to work and be financially resilient, that not only do we have to think about the breadwinners that are bringing in money, but also the caregivers and the homemakers that help those structures work and keep those breadwinners doing what they're doing. And more often than not, we are finding that women are the breadwinners. And in a lot of cases, we're finding that the women are perhaps the main breadwinners in their homes now, which, challenges the old notions that, we were looking to talk to men when it came to incomes.
From my perspective, Harvey, it's been great to have those conversations in the office. And actually, editorially now, people may not realise, the listeners may not realise that the women outnumber the men on the editorial team. And that's been great for these conversations that we have. And not only that, it's been great for this very podcast, because if you rewind to 7-8 years ago when we started, it was heavily male dominated, and the topics being brought to the podcast were obviously just being researched by Damien, and Damien and I would discuss those. There was very, very little female influence. And now we are having conversations in the office that are being put to Damien, and straight away he's throwing it over to that person to say, right, that's brilliant, you run with that. And more often than not, that will be a female member of the team. And again, it's nice to have that female perspective on the podcast.
Yeah, so, hearing what Harvey has to say, what Lauren has to say, what Laura has to say, and what they find in their particular spaces within personal finance has just enriched that conversation even further. But yet we keep it to the same accessible conversation that everyone can understand and take something away from, which ultimately is our goal at Money to the Masses. What we want to do is say we're inclusive. We were already inclusive because what we were doing was really battering down the door of elitism and bringing this to people across the spectrum, regardless of what you earned. And you could hear two normal guys talking about stuff. But what's happened is that's expanded now. Now we've got another group of people, and their voices are coming through. And that just means we're being more inclusive, and hopefully our audience is widening and we're appealing to an even larger group of people.
Harvey, I love you coming on the podcast because you talk so articulately about these things. Thanks so much for coming on. And there's lots of stuff in there, food for thought. And actually, there are things happening in the background that we've been doing on the back of everything that we've been preparing and producing around Grow It. And it's just reminded me that we've got an event that we're busy beavering away on in the background, and that's our Women in Investing event. Now, we have yet to get a date for that. We're going to cement that very, very soon, so do listen out for it. We'll be mentioning it on the podcast in the weeks to come, but we're going to be having guest speakers. So if there's anything that you wanted to hear about, any particular guests you wanted to come on to that panel, then do get in touch, because it's something we're really looking forward to putting together. So listen out in the coming weeks. Harvey, thanks for coming on. Okay, so let's bring Laura in then. Laura, thanks ever so much for coming back onto the show again. You're going to be talking about mortgages and the latest state of play, really. You've written an article on the website. What's going on?
So we've started to see a real shift in the mortgage market from last year, where we had obviously a huge amount of activity in the housing sector, and a lot of people looking for mortgages around that 60% LTV mark. That was where there was a real kind of price war amongst different lenders. Rates were at an all-time low because of the Bank of England dropping the interest rate because of the pandemic. And the market really heated up, and there was a lot of activity in that 60% LTV area. And by that, I mean when people are paying a 40% deposit for the property that they're buying. Fast forward to March 2022, and what we're seeing is a change in the types of products that lenders are offering, and also a reduction in the total number of products that are now available. So obviously we've seen two increases in the Bank of England base rate, one in December and one in February, and quite naturally those increases have started filtering through to the end mortgage products. What we've also seen over the last month has been 500 mortgage products being pulled by different lenders. So while there's still over 4,000 products available, people aren't going to struggle necessarily to find a mortgage. There is less choice. And what we're starting to see is lenders actually pulling quite a large proportion of their range, or even temporarily suspending some of the products that they've got on offer. One example of this has been TESB, which announced that it is temporarily withdrawing a lot of its about 2, 5 and 10-year fixed rate deals. So yeah, it's something to be aware of if you're looking to buy a property or if you're looking to remortgage. In addition to that, what we're seeing is rates are going up over and above what you'd expect from the interest rate rises. So we have seen 5 consecutive months of increases for both 2-year and 5-year fixed rate deals. So the average 2-year fixed rate mortgage is now 2.65%, which is the highest it's been since November 2015. So it's quite a substantial change. Putting that in context though, with the historical average of interest rates being around 5% and mortgage rates higher than that, it is still relative to history quite a low rate. Meanwhile, for 5-year fixed rate mortgages, they are currently at 2.88%, which is the highest level since April 2019. So we're just starting to see a trend upwards in prices, and it's something that people need to be aware of and perhaps be looking to get good advice from a good mortgage broker who's going to be able to help them find the best deals that are still available on the market.
Okay, so that's interesting. Obviously, things are changing in the mortgage market at the moment. So is there anything that's really driving these changes apart from the obvious, the interest rate changes?
So the interest rate change is at the heart of a lot of these changes. But what I would say is we're also starting to see the effects of lenders just wanting to reduce their overall risk. I think that quite naturally, with the economic situation as it is at the moment, a lot of uncertainty about how things are going to pan out, lenders must be thinking of the risk of greater numbers of people defaulting on their mortgages. Obviously, we're also seeing a big rise in the cost of living. Energy prices have increased, which we've covered on the podcast before. Just generally, inflation is high. Everything is becoming more expensive. And that is going to start filtering through then to defaults with mortgages. And it also affects the affordability assessments that people have to do when they're applying for a mortgage. So they may not qualify to borrow quite as much as they would have before because they won't meet those quite strict affordability criteria.
Okay, so listening to that, it kind of sounds all doom and gloom, but is there anything sort of positive we can take from this? Are there any winners?
Yeah, I hate coming on here and being the bearer of bad news with this kind of information. Happily, there is an area that is experiencing some good news. So for first-time buyers, especially those looking to buy at the 95% LTV level, there are actually an increase in the number of products available. So if you're looking to buy a property and you've only got a small deposit of around 5%, there are still options available to you. And actually, there are slightly more products that you can apply for now than there were a month ago. So in that area, at least, things are looking up.
Okay, Laura, thanks ever so much for coming on the show and updating us on all of that. Damien, let's bring you back in then. If you want to get in touch with Damien, you can do so in the usual way. It's Damien at moneytothemasses.com. Twitter, it's at moneytothemasses with the number 2. We're on Instagram, TikTok, YouTube, and all the usual places. Don't forget, if you haven't subscribed to the newsletter, do that, because all of the stuff that Damien just talked about is included within the newsletter each week. Just go to the site, it's moneytothemasses.com/newsletter. And so that's it. Damien, we're pretty much done, aren't we?
That's it. We're done, Andy. So until next time.
Until next time.